Financial corporate statement. Simple financial statements are information about company finance that can be used to see how the company is performing in a certain period. With the existence of a financial report, leader or management can see more clearly the company financial condition based on actual data about the company's condition. A good company, of course, must have a good and orderly financial reporting system. Without financial report, companies will find it difficult to analyze what is happening in the company and how the condition and positioning of the company is. At least there are four types of financial statement in accounting. To find out the financial condition of a business, you can study and use financial report as below. First, income statement. As the name implies, this type of financial statement serves to help you to find out whether business is in a profit or loss position. If the company's revenue is greater than the expense or cost, then the business makes a profit. Conversely, if income tends to be less than expense or cost, then the business is likely to suffer a loss. In general, there are two methods used to prepare an income statement, namely single-step direct method and multiple-step stepwise method. The single-step method is relatively easier than the multiple-step method. You only need to add up all the income from top to bottom into one group. Then subtract the total expense or expense in the applicable period. Meanwhile, in the multiple-step method, income is separated into two categories, namely operating income of the company and non-operating income of the company. The division of categories also applies to expense or expense. Second, report on change in capital. In running company corporation, of course, the initial capital invest will experience change. This change occurs because capital must be used in running the company as well as because of the addition of profits, the use of capital for the benefit of the company owner, or other things. A report or change in capital, or what is commonly called a capital statement in accounting terms, is a type of financial report that provides information about change in the company's capital or equity in a certain period. This report change in capital serves to show how much capital change have occurred and what caused the change to occur. Third, balance sheets. A balance sheet is a type of financial statement. It presents the assets, liability, and capital account in period. The balance sheet usually consists of two forms, namely the outline horizontal form and the vertical or staff form. The value of capital on the balance sheet is the value recorded in change in capital report. Balance on the balance sheet can be achieved because the change in capital report already consists of income and expense that are recorded in the profit and loss statement. Assets are assets owned by the company with the future economic benefit. Example include truck, cargo cars, and forklift car. For other assets consist of current assets and tangible fixed assets. Liability consists of current liabilities and long-term liabilities. Capital is the company asset owned by the owner of the company. Capital will increase if the owner of the company adds his investment in the company and if the company makes a profit. Conversely, capital will be reduced if the owner of the company takes the investment fund if the company experiences a loss. Fourth, cash flow statement. This type of financial report is very important to find out the flow of fund in the company, where the fund or cash go and where the cash come from. This is to that the company can control the fund or cash the company has had so far. The cash flow statement. Cash flow serves to provide information about cash inflows and outflows. Report on cash flow. Cash inflows can be seen from several sources, namely the result of operational activities and cash obtained from funding or loans. Meanwhile, cash outflow can be seen from how much the company incurs both for operational activity for investing other business.
Assalamualaikum warahmatullahi wabarakatuh. Hello guys, in this video we will discuss about accounting and corporate financial report. Firstly, we discuss accounting. Accounting is the process of recording, summarizing, classifying, and processing in order to present transaction data to product financial report. This financial report will be used by internal and external parties to determine business decisions. For internal parties, financial statements are used as a basis for consideration in determining company policy. External parties use financial reports to calculate tax rates and investment decisions. Types of accounting. Types of accounting also vary according to the goals and interests of the user. Most people only value financial accounting even though the type of accounting itself reaches 12 types, including the following. First, financial accounting. Financial accounting is a part of accounting that focuses on the presentation of corporate financial statement. The financial statement themselves consist of a balance sheet, income statement, cash flow, and change in capital. Financial accounting is concerned with recording financial transactions and preparing financial statements based on generally accepted accounting principles. Second, management accounting is a system that deals with the use of accounting information that is useful for management in an organization. Management accounting functions to control the company so that the business it runs smoothly and does not suffer loss. Third, auditing. Auditing is often known as audit accounting. The purpose of auditing itself is to thoroughly examine financial transactions and reports. With auditing, financial reports are presented to be more transparent, reliable, and objective. Fourth, Sharia accounting. Sharia accounting is accounting based on Islamic values or Sharia. Sharia accounting implement all accounting process in Sharia such as following Islamic laws. Islamic accounting itself emerged because of the rapid growth of Islamic banks. Fifth, banking account. Banking account is accounting related to operational activities and financial data of banking institutions. Banking accounting is the same as general financial accounting, but there are different in the accounts. In banking accounting, there is a special account used for financial institutions, and there are two recording systems, namely an accrual basis for recording expenses and a cash basis for recording income. 6. Cost accounting. Cost accounting is the activity of recording, measuring to the process of financial reporting by classifying and summarizing production costs. The focus of cost accounting is the cost of production to determine the cost of a product. 7. Government accounting. Government accounting is closely related to state finance. Government accounting regulates budget execution and report on budget distribution in a more transparent and accountable manner. This accounting is often used for bookkeeping for non-profit institutions. 8. Tax accounting. Accounting deals with tax calculation. This accounting is used to calculate the amount of corporate taxpayers and personal taxpayers. The tax accountant, the tax accountant, our job is to prepare tax report that can be used for tax planning and policy with tax return. The tax accountant also analyzes and estimates the company tax potential in the future. 9. Accounting education. Accounting education focuses on the work of accounting education. This accounting includes processing financial transaction data and presenting financial report for educational institutions. 10. Accounting information system. The accounting information system is the part in charge of making planning schemas and implementing procedure in processing financial transactions. As financial information, the accounting information system will simplify and streamline transaction data to make it easier to process. 11. Social accounting. This accounting is in charge of handling the financial process in terms of social impact that impact the economic activities of an entity. Social accounting is also known as responsibility accounting. 12. International accounting. This accounting deals with international trade. Its application is through a comparison of accounting principles between countries and harmonizing accounting standards in the world. Difference in accounting standard may occur due to the influence of business culture, politics, regulation, and currency values.